The market is once again flirting with all-time highs, even as headlines scream about tariffs, geopolitical tensions, and election year uncertainty. This kind of resilience would have been unthinkable just a few years ago. And yet, here we are. Stocks climbing steadily, confounding every bear who predicted a crash, a bubble burst, or a recession. But something changed after late 2022. Ever since the ChatGPT moment, the market hasn't just recovered, it's redefined itself. That moment wasn't just about a new AI tool. It marked the beginning of a new secular bull market driven by an unstoppable force: artificial intelligence. This isn't a hype cycle, it's a structural transformation. Analysts now argue that we are only in the opening act of the AI revolution, where breakthroughs in large language models, chip architecture, robotics, and enterprise software are accelerating faster than anyone predicted. According to Marianne Bartels of Sanctuary Wealth, what we're witnessing is a global, innovation-led bull market, one that spans not just US equities but Europe, Japan, and emerging tech worldwide. She believes this wave is powered by rising productivity, surging corporate earnings, and a world finally learning to monetize disruptive innovation. And she's not alone. ARK Invest's Cathie has repeatedly said that AI and related technologies will be the greatest source of deflationary pressure this century. Her team sees technologically enabled productivity not just offsetting inflation, but transforming the global economy with explosive efficiency gains, lower interest rates, and soaring equity valuations. In today's video, we'll reveal 3 powerhouse stocks that not only defy the skeptics, they're roaring higher despite headwinds. These companies aren't riding the AI trend, they're shaping it. And if this secular bull market continues as predicted, they could be among the biggest winners of the decade. First on the list is Nvidia Corporation, ticker symbol NVDA, a company that's no longer just powering the AI boom, it's architecting it. While most investors still associate Nvidia with GPUs, the real game changer is the company's shift toward full-stack AI infrastructure, especially its rapidly scaling Omniverse platform. Think of Omniverse as the digital twin of the physical world, a simulation engine that renders entire factories, robots, and even cities in photorealistic 3D. From BMW optimizing entire production lines to Amazon training warehouse robots, Omniverse is proving to be more than a futuristic concept. It's becoming foundational infrastructure for the AI era. Here's why that matters. Modern AI agents, especially those aiming for general intelligence, need synthetic training grounds that are faster, cheaper, and safer than the real world. Nvidia's Omniverse provides exactly that, a high-fidelity sandbox where robots can rehearse, refine, and perfect their tasks thousands of times faster than in real life. That demand creates a flywheel. More simulation means more compute. More compute means more reliance on Nvidia's chips, cloud infrastructure, and proprietary software stack, creating a recurring, sticky revenue stream well beyond one-time GPU sales. Despite export restrictions to China and fierce competition from AMD, Nvidia continues to dominate with over 90% of the data center GPU market and is growing data center revenue at a staggering pace. Its first quarter results blew past expectations, with over $39 billion in data center revenue and free cash flow topping $70 billion over the past year. What's even more impressive is Nvidia's vertical integration, from silicon to simulation, locking customers into its ecosystem with CUDA, DGX Cloud, and proprietary interconnects. In the broader macro context of declining rates and disinflationary tech-led productivity gains, Nvidia stands at the center of a once-in-a-generation shift. As AI transforms every sector, from manufacturing to healthcare to autonomous systems, Nvidia isn't just enabling the revolution, it's laying down the tracks. Next up is Microsoft Corporation, ticker symbol MSFT, and if there's one tech giant quietly but forcefully reshaping the enterprise AI landscape, it's this one. What sets Microsoft apart isn't just the magnitude of its AI investment, though its $100 billion bet is staggering, it's how seamlessly AI is being woven into the company's already dominant software ecosystem. Instead of chasing AI as a standalone business, Microsoft is transforming existing products into AI powerhouses. That's what makes it so compelling right now. Take GitHub Copilot. What started as a simple coding assistant is is now evolving into an indispensable development partner used by over 15 million developers, or Microsoft 365 Copilot, where AI is now embedded in Word, Excel, and Teams, rapidly becoming a must-have across the modern digital workspace. Enterprise adoption is exploding. Customer counts for these products have tripled year over year, and even more impressively, companies are coming back to purchase additional seats. In the world of software subscriptions, that level of stickiness is gold. Then there's Azure, Microsoft's cloud backbone, which grew 33% year over year in Q3, with nearly half of that growth driven by AI workloads. This isn't a company talking about AI revenue. It's already generating it at scale. Microsoft is building new data centers across 10 countries just to keep up with surging demand for compute power. Yes, there are challenges. The company faces delays in its in-house AI chips and rising capex driven by reliance on Nvidia GPUs. But those investments are laying the foundation for long-term dominance. Even the friction in its partnership with OpenAI hasn't slowed Microsoft's momentum. Instead, it's doubling down on its internal AI roadmap, determined to control its future. In a world where AI is becoming the default layer for all productivity, Microsoft isn't scrambling to catch up. It's already embedded, and that's why this stock continues to stand tall, even when the market throws curveballs. Last but definitely not least is Amazon.com Inc., ticker symbol AMZN, a company that has quietly shifted from being just an e-commerce titan to one of the most critical players in the AI and cloud revolution. While the stock has already delivered a solid 21% return since late 2024, what makes Amazon compelling right now isn't just past performance, it's the multiple catalysts lining up for the quarters ahead. Let's start with AWS, Amazon's cloud business. Although it reported 17% year-over-year growth in Q1, that number was held back by capacity constraints. CEO Andy Jassy recently confirmed that Amazon's AI business is already operating at a multi-billion-dollar run rate and growing at triple-digit percentages. The only thing slowing it down? Hardware supply. But that's about to change. With a wave of Trainium 2 and next-gen Nvidia GPU instances hitting Amazon's infrastructure later this year, AWS is poised for an acceleration in growth. As supply catches up with demand, this could become a major driver of revenue and profitability moving into Q3 and Q4. On the retail side, Amazon's competitive edge is about to sharpen. Amid high tariffs and global trade reshuffling, Amazon's average prices remain 14% lower than other major US retailers. That makes it a natural winner in an inflation-sensitive environment. As tariffs become a semi-permanent fixture in global commerce, Amazon's scale and direct sourcing model give it a structural advantage, especially over brick-and-mortar retailers with tighter margins and less pricing flexibility. Then there's valuation. Despite the recent rally, Amazon still trades below its historical operating cash flow multiple and maintains a premium only because its earnings growth is expected to outpace nearly all peers. With margins improving and AWS returning to form, this stock is positioned as both a growth story and a defensive play. In a market full of noise, Amazon is executing. Whether it's cloud, AI, or global retail logistics, it's hard to find another company so well positioned for what's next.